Good afternoon. This is Michael Kimmel, and I'm happy to welcome the almost 250 registrants to RPB's Summer 2021 installment of our quarterly webinar series. I do hope that everyone is healthy and has been able to enjoy summer so far. All of us here at the RPB, thank goodness, are continue to be healthy and are doing well with working from home. But we are looking forward to returning to the office on a part-time basis later this fall. In addition to myself and Len Teitelbaum, chair of the RPB board, joining us today are David Baskin, chair of our investment committee and president and founder of Baskin Wealth Management, and Brad Smith, partner with NEPC, RPB's outside investment consultant. Now, before I turn it over to Len, who will provide some opening remarks, a few things. As always, the webinar is being recorded and will be posted to our website in a few days. We also will email a link to you. Regarding questions, thanks to those who submitted them in advance. We'll address them at the end of the session, as well as those submitted during the session, which you can do anytime by clicking on the Q&A button found at the bottom of the screen. Len, the floor is all yours.
Well, thank you, Michael, and good day to everyone. You know, I feel that today's call is particularly noteworthy as it ushers in continued expansion of choice for the participants of the RPB. Beginning several weeks ago, you were all notified that 2 new funds were added to our Tier 1 menu. Now this, you've been notified by snail mail, email, postcards. Point is, we tried to alert you to this, and hopefully today's program will add some meat to the bone. Now this effort represents the combined efforts of your board, your investment committee, and the work of our outside advisors, NEPC. Now, it should be quickly added that it was Herculean efforts by Alice Gunn and Michael Kimmel that allowed this advancement to occur. Now, I spent 42 years on Wall Street in both research and investment banking, and have participated in several launching endeavors similar to this. And I unabashedly state this was a great accomplishment by those involved. Please pay particular attention to the how-to part of today's presentation to utilize these new funds in Fidelity. Thanks also to Stephanie Berger, your Director of Marketing Communication, who did a magnificent job of alerting you to the existence of the new funds and instructions on how to use Fidelity to help make choices if you so choose. Please visit our website for further instruction. Now, it also may be of special interest to note the results to date of our unique Reformed Jewish Values Investment Funds. Please note this during the funds review, which will begin momentarily. Let's look at the agenda, and we're going to try and follow it as closely as we can. And Brad, on with the show.
Great, thanks, Len. So before I get into the mid-year update, I do want to apologize in advance. I have a little bit of a summer cold that settled in last night, and I'm a little froggy today, and I might have to go on mute if I have a little bit of a persistent cough, but I'll be right back. But every quarter, NEPC has key market themes that we use to try to identify the primary drivers of markets over the next 3 to 5 years. And you see those themes at the bottom of the slide. And what we've seen so far in the first half of 2021 is that the permanent monetary and fiscal interventions are the most dominant theme right now driving markets. And what we've seen is not just in the US, but a coordinated effort from global central banks across the globe to provide fiscal and monetary stimulus to really lessen the impact from the COVID issues that we've all faced. One of the benefits of that is it has kept interest rates very low. Those low interest rates really do help support higher equity valuations. One of the things we do recognize is that although we expect these themes to be persistent over the intermediate to longer term, if there is a disruption to any of these themes, it can really drive volatility over the short term. On the next page, what you'll see is the performance of the broad markets for Q2 2021. And the nice thing is everything's above the horizon, which means that all of these asset classes did generate positive returns across the board. And you can see that the equities were up single digits. If you go all the way to the right, you can see that commodities had a absolutely spectacular quarter. We'll get into that in a few minutes. If we go to the next page, we did see growth outperform value across most of the markets in Q2. So what you'll see here is the dark blue bar is showing you the return of the growth portion of the various indices here, and the light blue is the value sectors. So you can see, especially with the Russell 1000, which represents the large cap US stocks, growth handily outperformed value during the quarter. If we go to the next page, what you will see is when we dig down below the surface to try to look at what the different sectors did during the quarter, you can see that on the dark blue bars, we're showing you Q2, and Q1 is the light blue bars. So there was a bit of a reversal. During Q1, value sectors did it much better. You can see led by energy and financials. But in Q2, technology and healthcare both did quite well. And we did see a return to the growth sectors actually doing quite well over the value sectors. One of the things we've been telling our clients is that depending upon how the vaccine rollout goes, and it's gone pretty well here in the US, if that did go well, we thought that there would be a reopening theme. And what we meant by that is we saw some pent-up demand out there, and we expected companies that to do quite well coming into 2021. So if you go to the next page, what you'll see here is we're showing you the S&P earnings per share forecasts. We're showing you the 2021 and the 2022. The real takeaway here is if you look at the beginning of the chart and the end of the chart, the forward earnings forecasts are actually back to where they were pre-COVID, which is very positive for stocks. So the equities are doing quite well. They're being buoyed by the low interest rates, and we're also seeing some pretty good earnings announcements that have come out. Now, there is one thing out there that is getting a lot of headlines out there, and that's inflation. A lot of investors are concerned about that. If you go to the next page, what you'll see here is we've actually charted over the past 12 months what the monthly prints for inflation have been. We've actually broken it out into different drivers of inflation. And you can see that as the US economy has continued to open up and the vaccine rollout has been successful, we've seen some higher prints of inflation. And you can see it was a little over 5% in June, year over year. If you look at the drivers of it, it's really been driven by energies and commodities exclusive of food. And a lot of people are worried about how is this going to work or how is it going to impact our portfolios. On the next page, you'll see that what we've done here is we've tried to look below the surface to see what the big drivers of inflation have been. And in our view right now, we believe the greatest likelihood for the inflation scenario is that it really is transitory, and it's really closely linked to the reopening theme. So we've got issues out there with cars. I'm sure you all have heard about the supply chain disruptions with chips has made used car prices go up very high. You can see transportation services, including airfares, those prices have gone up, and shelter. The big driver in the shelter sector is really just the hotels. So while there's a lot of concern about inflation, our view today is that The greatest likelihood is that this is a transitory issue. The nice thing is your portfolios are very diversified, and you do have some inflation sensitive assets in your portfolios, as well as equities do incredibly well with low to moderate inflation. So with that, I'll turn it over to David.
Thanks very much, Brad. This is our famous quilt, which shows the return on various asset classes over different time periods. The year to date is the third from the right that has the black box that says Alarian MLP at the top. We show you this quilt to show you how variable the return is on different asset classes, and no more apparent than it is in this period. Alarian MLP, which basically tracks returns on energy-related products, is at the top of the heap, as you might expect when you saw Brad showing you how important energy had been in the first quarter of the year. But if you look at 2020, the column 1 to the left, you'll see that Alarian MLP was at the very bottom of the heap for 2020. So it's a total reversal. Similarly with real estate, the second best performing category in the first half of this year, the equity real estate investment trusts, up 22%, was the second worst performing category in 2020. What this means is that, in our view, trying to guess which particular asset will be the winner in any particular period is a mug's game. And the only possible response to this is broad diversification, a policy that the RPB has always pursued. Could I have the next slide, please? Now, somebody once told me that in a bull market, everybody's a genius. And certainly, if I was smart and a genius, what I'd say is the numbers speak for themselves, and I would just shut up. All of our products outperformed the index, and not only that, produced stellar returns during the first half of the year. The focused growth fund, our most aggressive category, had a 13.9% return for the first half of the year. That's stellar by any measure, but not only that, it outperformed its benchmark by better than 1.2%. Our growth and income fund, which combines the equity growth assets with the more conservative yield-focused income products, returned 8.2%. Again, a stellar return, and again, a tremendous performance over the benchmark, better than 2%. And our focused income fund had a very modest positive return of 1.5%, but that was 3% better than the benchmark for that, the Barclays US Aggregate Fund Index. Finally, I'd like to point out the performance of our Reformed Jewish Values Stock Fund at 13.2%. The RJV product had been outperforming the broad index. This particular period, as we saw, energy was an important component. Because the RJV de-emphasizes companies with a heavy carbon footprint, including most energy producers and explorers, it outperformed when energy became a very significant component. Nonetheless, a very solid contribution and a solid beat over its benchmark. So all participants should feel very happy about how their funds did, almost regardless of what product that they owned. Next slide, please. The other measure, of course, is volatility. It's one thing to get good returns. It's another thing if you're taking very high risk in order to do that. It's gratifying to me to see that our growth product, our most aggressive fund, not only outperformed its benchmark in terms of return, but did so while taking less risk. On this particular slide, lower is better. And the fact that our standard deviation was smaller than the benchmark means that we did well without taking crazy risk, in fact, taking less risk. The growth in income fund had slightly more volatility than the index, as did the focused income fund, not by significant amounts. And as we saw in both cases, their performance was even better than that of the focused growth fund compared to the benchmark. Next slide, please. Our tier 2 products are passive products, which participants can select if they wish to have very low management fees and wish to track a particular index. As you can see, in every case, these products did track the index that they were supposed to track. The winning asset class, as we saw on the quilt, turned out to be real estate during this particular half year. And the loser was the bond index, which produced a negative return. But all the stock categories were very positive returns for the period. And tier 2 did quite well as a result. Next slide, please. So I'm now going to hand it back to Brad, and he's going to give you the NEPC projection for the second half of the year.
Thanks, David. So as I mentioned earlier, we really do expect these 4 themes at the bottom to be the primary drivers of returns going forward. And I wanted to get just a little bit deeper into all 4 of them. So if you go to the next page, what you'll see here is going into 2021, NEPC had both the trajectory of the virus as well as permanent interventions as the dominant themes that we viewed would be driving markets. As the vaccine rollout has been pretty successful in the US, it's been less successful elsewhere in the world. So we still see this theme as prevalent. And to the extent the Delta variant would lead to additional lockdowns, this could very easily go back to a dominant theme later in the year. But right now, where we sit today, we really do believe that the Fed being incredibly accommodative is going to be really the driver and support equity assets. So we view that as a positive. I would say the risks out there right now are the globalization backlash, and that's something that we've continued to see out there. You know, one of the sad things about COVID is that the divide between the haves and the have-nots actually did widen pretty substantially during the COVID lockdowns. We do think that this is prevalent. It's likely to drive volatility, but it's not something that is really dominant like the permanent interventions. We view the globalization backlash as something that's going to drive volatility, less so returns. And then as China continues to transition to an emerging economy, and China really is the growth engine for global GDP these days. And we are starting to see a little bit of noise out of China, but right now, in our view, that is a neutral risk right now. But the permanent interventions and the virus trajectory and globalization backlash are going to be the key themes to watch. On the next slide, I did make mention of the big reason we downgraded the virus trajectory is essentially anybody that wants to get a vaccine in the US can get one. That's not the case in other countries across the globe. So we really do believe that assuming the virus doesn't return with another variant and we don't have additional lockdowns, that our reopening theme is going to continue to drive markets. And then on the last page I'm going to cover here on the outlook on the next page is really just the elevated permanent interventions. So this is showing you the Fed's balance sheet. And you can see how quickly it grew right at the beginning of COVID. That was incredibly beneficial to investors as it really provided a lot of liquidity and support for stock prices. you'll see that the projection is that the balance sheet is going to continue to grow. And we view that as an accommodative policy. So this is why, in our view, this is the most important theme out there that's going to be continuing to drive markets, especially on the equity side. So with that,
Thank you, Brad.
turn
I'll
over
take
my-
over for here. This is Michael. We're now going to transition and talk about our funds, specifically our Tier 1 funds, our newly labeled target allocation funds. First, I want to spend just a couple of minutes reviewing do an overview of our investment choices. As you know, our investment options are grouped into 3 tiers, really based on how involved the participant wants to be in building their portfolio. We designed these tiers very, very thoughtfully. Tier 1 is composed of our target allocation funds. These are pre-diversified funds for those who really don't have the desire, time, or knowledge to select their own investments and really want a simplified approach to investing. With these funds, we've done the asset allocation for you. You simply choose the one fund with a mix of equities and bonds that aligns with your current tolerance for risk and your financial goals, and that should really suffice for your needs. You'll hear more in just a bit about how you can use these funds the new funds, I should say, that launched on July 15th. You notice a little asterisk. The new funds are the Moderate Growth Fund and the Moderate Income Fund. And at the same time, you've heard that we renamed all of our funds to be consistent. Tier 2, those are comprised of our self-directed funds. They span a range of single asset classes and are suitable for those participants who are comfortable with building their own diversified portfolio or have a financial advisor to help them do that for them. And then finally, Tier 3 is comprised of our socially responsible funds for participants who really want to build a better world while saving for retirement. And of course, that's comprised of our Reformed Jewish Values Stock Fund. Now, why did we make the change? We really wanted to really emphasize a simplified approach with Tier 1, and which is why we added 2 additional funds to make the transition from the growth stage of your investing, saving for retirement, to your more income stage of your saving for retirement smoother. As I mentioned, each of our 5 Tier 1 funds is built with a specific or targeted mix of equities and fixed income to match your goals, risk tolerance, and time horizon at any point in time. This means you don't have to diversify your portfolio on your own. Like I said, this fund does that for you. Before we talk a little bit more about the funds, I'm going to turn it back over to David to talk a little bit about some of the basic principles that guide your investment selections.
Thank you, Michael. When our participants choose how to allocate the assets in their fund, there's some basic principles of portfolio management that should be kept in mind. When we looked at the quilt, we saw that asset classes are fundamentally unknowable. Nobody can guess how the stock market will perform in any year or period, or how interest rates will move, or what commodity prices will do. Brad and the very smart people at NEPC use a huge amount of brain power working on that. But it's fair to say that even they could not have guessed that oil would be the star asset of the first quarter of 2021, or that real estate would be the star in the second quarter of 2021. These things react to a huge number of factors that interact in a way that nobody can guess. The only real good defense for this fundamental unknowability is diversification. At the RPB, in our managed products, our Tier 1 products, we've taken a lot of effort and time to come up with a broad spread of assets in each of the offerings, so that a participant, whether they choose any of the 5 products which we'll outline, will be certain of getting a diversified portfolio which will not expose them to the risk of sinking their portfolio if they've made a bad choice. It's certainly true that in some time periods, assets all move in the same direction. And we saw that, for example, during the start of the COVID market drawdown. It didn't really matter what you were invested in. There was a generalized market drawdown. But over time, having diversification allows you to benefit from the good assets without having the bad ones drag you down too much. So asset allocation, fundamental principle of portfolio management, one which the RPB has taken great pains to build into each of the tier one products. Next slide, please. The second fundamental thing that every participant needs to address, and needs to address on a periodic basis, is the fact that as one grows older, one's objectives change, one's risk tolerance changes, and one's need for income changes. And fundamentally, the amount of time that one has left before retirement or during retirement also changes. So that a 45-year-old participant who is growing her or his portfolio with the aim of making it large enough to support a prosperous retirement will certainly have different goals than a 75-year-old participant who's already retired and is making sure that the funds in the plan will suffice until the end of her or his life and provide the means for a comfortable retirement. So generally speaking, portfolio management theory says that the more time you have left, the greater risk you can take. And we certainly expect to see younger participants invest funds in the more aggressive parts of the portfolio. That is, in the case of tier one, the growthy part of the portfolio, and that as they age, they will move to the right towards the more income-focused aspects of the portfolio. Probably some participants have seen products offered by others called age-focused funds. This is a similar idea. The 5 managed products in tier one take care of that for you. But your job as a participant is not to be idle or complacent. You must review your needs over time and think about which category you should be in as you progress through both your retirement and before that, your career, and how much your risk appetite has changed and how much your need for income has changed. Next slide, please.
David, before I move on, you mentioned growthy-oriented investments versus income-oriented investments. A question had come in to please define what we mean by growth versus income.
So I think the easy way to do that is to contrast a company like Apple with a company like AT&T. When you invest in Apple, you're investing in innovation, exciting new products, new streams of income. AirPods, for example, the wireless headphones that it seems like everybody under 50 owns, are already a huge product for Apple that didn't exist 2 years ago. We remember when iPads came out and replaced laptop computers for others. Investing in a company like Apple is investing in innovation and growth. Whereas a company like AT&T, which has assets that we're all familiar with and which we've all used for all our lives, is primarily a company in which one invests for income. AT&T pays a very large dividend. It's what we would call a stodgy, slow-moving company, not big on innovation, not big on new products, but very stable, very solid, and hard to imagine anything really horrible happening to it. So when you invest in Apple, you're taking the risk that a product launch could fail, or that a competitor could arise and take away market share or take away profit margin. It's therefore inherently more risky, but has the possibility of much greater returns. When you invest in a company like AT&T, you're saying, I'm prepared to forego that growth in order to get steady income.
Thank you, David.
Thanks. Could we have the next one, please?
Oh, sorry. I jumped ahead. Last one.
So I spoke about risk tolerance. The fact of the matter is the stock market goes up and down. We've seen that really over the course of the last 18 months. In March and April of 2020, the major stock indices, not only in North America, but also in Europe and Asia, fell by as much as 30 to 40% in a period of 6 weeks. That's a pretty steep decline, and people who thought that they had pretty good risk tolerance were put to the test. Were they able, in fact, to sustain that temporary loss and to take the risk that it might become a permanent loss? One does not know that the stock market will bounce back or when it will bounce back. So when we are heavily invested in the stock market and in growth assets, we're taking that kind of risk. Certainly a risk that a 40-year-old can withstand better than an 80-year-old, because after all, the 40-year-old has a lot of years in which to make up those losses. Risk is partly a emotional thing and partly an intellectual thing. The fact of the matter is we all want to sleep at night. And even though your brain might tell you that the stock market always bounces back over time, if your kishkas are keeping you awake all night, that necessarily means that you should be taking less risk. Our tier 1 offerings graduate risk in 5 different levels, decreasing equities and increasing bonds systematically as we go across the spectrum, allowing participants to choose the risk level with which they're the most comfortable. Next one, please. We've devised a completely diversified portfolio in each of the tier 1 products. And as you can see, by looking at the rings, the products take you from 95% equities in the focused growth fund on the left through 75%, 55%, 35%, and finally 15% equities on the right. We have designed this so that the participant only need choose one of these 5 products to get the diversification that they need, and they can choose the one which best suits their time horizon and their risk profile at wherever they are in their stage of their career or their retirement, bearing in mind that they must pay attention and over time decide if they want to move along the spectrum, generally from left to right. So that's what we've done in tier 1. And next slide, please.
Right,
This gives you an idea of all the products
right.
that are in each fund. One question that we had, Michael, if I'm not mistaken, is do you get the same stuff in each of the 5 products, but in differing amounts? The answer is yes, you do. The same managers appear in each of the 5 tier 1 offerings, but as one goes from left to right, from growth to income, of course, necessarily one gets less of the stock picks and more of the bond picks, but the managers are the same.
Correct. And I think we're going to turn it back to Brad for just a minute or two to talk about the construction of the funds.
Yeah, so if you could go, so one of the key objectives of these target allocation funds is, if you can go back one slide real quick, Michael, is we've structured these to be incrementally less risky as you go from left to right. And what you'll notice is that the equities drop by 20% between each of the portfolios as you go from more conservative to less. And the way you should be thinking about this is, what is your investment horizon? If you've got a really long time before you're going to need to access these funds, then you really should be looking at something on the left-hand side of the page. If you're getting much closer to retirement, or if this is a big portion of your wealth, then you need to be looking more towards the right-hand side. But only you know. Fidelity has some great tools that they can take you through these things. The other thing I wanted to let you know, and if you go to the next page, Michael, real quick, is,
Brad, I'm sorry
yes,
to interrupt here.
yeah,
A question did come through as we were talking on this slide about this slide. And the question is around discuss how the funds have changed. And what I'm interpreting this question is about how have our existing funds have changed. And while I got the microphone, I'll jump in real quickly. So the RPB Focused Growth Fund, which was the Capital Appreciation Fund, fundamentally it's the same fund with a subtle difference. And that subtle difference is that it had been approximately 90% equities and 10% fixed income. And we actually increased that to 95.5. So that's fundamentally the only change made there. The Growth and Income Fund had been approximately 55 equities and 45 fixed income. So that hasn't changed substantially. And then on the Focused Income Fund, which was the Income Focused Fund, that was approximately 10% equities, and we actually increased that subtly to 15% equities and 85% fixed income. So I just wanted to highlight some of the subtle changes we made, in addition to the underlying investments, which we made more consistent, which Brad, you'll go through on the next slide.
right. So thank you. The other change was that we added a new asset class, which is global equity. And we have that split between a value manager and a growth manager to give us broad exposure to the global equity markets. But that was really funded entirely by the assets above that. You'll notice that from an equity perspective, as the risk goes down and the equity is reduced, it's reduced proportional across each of the portfolios. So the same ratio of US stocks to international to emerging market stays consistent regardless of where you are. Then on the fixed income portfolio, as the fixed income becomes a larger and larger percentage of the portfolio, if you look at the very bottom short-term bonds, you'll see that the short-term bonds actually only show up in the moderate income and the focused income, but the everything else is the same with the other target allocation funds from a fixed income perspective. So really a little bit of tweaks, but not material. I would say the biggest thing we've done is added 2 additional choices for participants to get a little bit more granular with your risk tolerance by adding the moderate growth and the moderate income.
Great. Thank you, Brad. And I do want to add that this chart really encapsulates a lot of the value that NEPC brings to us at the RPB. They're the team, Brad and his team, Brad and Asher Watson and some folks behind them even have helped us design these portfolios, helped us select the right manager. So you see each of our asset classes has a unique manager. So helped us select the best in breed, the best of class managers for each specific asset class. A lot of work and thought and research goes into designing these funds and picking these managers. And so, we want to thank Brad and his team for helping us get to where we are today. All right, so just to recap, we talked a lot about our target allocation funds, and this is the idea is that you want to look for if you're looking for a simplified approach where the asset allocations decisions are made for you. You just saw the chart. You may want to consider investing in our tier 1 funds. Of course, as been said by David and Brad, you'll need to adjust the investment over time when your risk tolerance or time horizon shifts. And of course, you can do that at any time by switching into another one of our single tier 1 funds. Now, having said all that, we don't want to forget about the fact that we do have other choices for you and other thoughts for you to consider. We're going to talk very briefly about how to use our tier 1 funds when you also want to further customize your portfolio for your very unique needs that those individual single funds may not be able to meet. For example, you might want a slightly different percentage of equities and fixed income other than, for example, 95-5 or 55-45. Or you might want to invest a portion of your portfolio in the Reformed Jewish Values Stock Fund. So we're going to talk very briefly about that. First, you determine your desired equity allocation. Then you need to decide how much, what percentage you'd like to invest overall in the Reformed Jurors Value Stock Fund, then give us a call, because we can work with you to probably help you design a mix of a single tier one fund, or maybe two tier one funds, along with the Reformed Jurors Value Stock Fund, for you to achieve your overall objectives for equities and fixed income mix. Now, if you're looking for a different tier one asset mix, just using tier one, for example, you want an 85% equities, not a 95% equities. We built a simple chart for you to look at that helps you to customize your portfolio just using tier one funds. It's at rpb.org/custom-allocation. It's easily accessible from our website. Take a look at that. Give us a call, and you could also review that with your financial advisor. Okay, enough about that. Last comment. We've talked a lot about asset allocation. We've talked a lot about tier one funds, but you also need to periodically check on your investments, log on to net benefits, make sure your asset allocation mix is aligned with your current situation. And if you're invested in more than one fund, right? And this only applies if you're invested in more than one fund. It's very important to make sure you're setting your account to rebalance, probably what makes the most sense on a quarterly basis, to your targeted mix of targeted mix between those various funds. There's a little photo for you from the net benefits site on where to find that. If you have trouble, we have some instruction manuals on how to do that. You could also call Fidelity, and they can help you walk through how to make those changes or set those rebalancing if necessary. And like I said, if you need help, you can call a Fidelity retirement planner who can help you select investments that might be right for you. Of course, you can always call us at the RPB. We have plenty of online resources for you, our fund fact sheets, our investment choice guide, which we just revised to reflect our new funds. That's all available on our website. And now for final announcements, and then we'll move on to Q&A. First of all, we want to remind everyone to sign up for one-on-one meetings with a Fidelity retirement planner. These are virtual and one-on-one with you. Just so happens we have 2 more slots open for tomorrow, July 28th, which you'll need to sign up for today. And we have 6 more slots open for tomorrow, for Thursday, July 29th, which you'll need to sign up by tomorrow. I mean, they need at least 24 hours to get those people signed up. You can always call Fidelity at any time, but these are special one-on-one sessions that we have a dedicated resource from Fidelity who can work with you. And then, of course, if you're interested, we have our annual retirement planning seminar scheduled from October 24th to the 26th. Unfortunately, it's going to be online again for, I think, obvious reasons. So hopefully we'll see many of you there this fall. Now, I'll turn it back over to Len, who will moderate a question and answer period for us. Len?
Thank you, everybody, for our presentation today. Now, we've got several questions that have come in. I'm going to do my best to try and group them as best we can. And Michael, I think I'd like to address the first one to you because it did regard fees and want to know if they're charged to participants' account, same for everything, et cetera. But please note, when we look at the performance in tier 1, it says net of fees, and tier 2 as well. So what you're seeing there is those are investment fees. Michael, will you want to address the fee question in general, please?
Sure. So each of our investments, each of the funds, the 5 tier 1 funds, all of the different funds in tier 2, plus the Reformed Jurors Value Stock Fund in tier 3, each of them has their own unique investment management fee, and that's dependent on the individual fund and how it's constructed. And so that's the simple answer to that one of the questions that came in. And I see another one. What is the management cost comparison between tier 1 and tier 2? So the fees for tier 1, the investment management fees for tier 1, by and large, are greater than the fees for tier 2 investments, and that is because the tier 1 investments, the tier 1 funds, are comprised of combination of passive investments. So for example, part of the large bulk of our growth fund, our focused growth fund, is the Vanguard S&P 500 fund, which has a very low fee. But it also has other managers underneath it, other investments where they're actively managed and where we pay more money. So that is why those fees are higher than our tier 2 funds, which are exclusively index funds and all passively managed. Now, why would one want to spend more in fees? Well, and sometimes you get what you pay for. And in the case of our tier 1 funds, and I'll let Brad add to this, we're paying for those managers to beat their benchmark. So in fact, this past year, I mean, in fact, last 3 years, our managers have done fantastic compared to their benchmarks. So we're getting greater return than we would have otherwise gotten had we only invested passively in certain types of asset classes, for example, emerging markets, international developed equities, et cetera. Even our core bond investment, which is not a great return, but even that investment has exceeded its benchmark. So we're actually we're getting what we're paying for, which is great news.
I think, Brad, I'd like to address the next question to you. There seemed to be, I think, some confusion when we talked about COVID and how it integrates into the investment thinking today, given the advent of some of the variants that are out there. Could you clarify NEP's position on COVID and giving its recent resurgence, how that might change your thinking?
Yeah, I would say that we did downgrade it because of how successful the vaccine rollout has been in the US. And one of the things we have noted is that it's still an important theme. It could become a major theme again, and that would be if there was a variant that arose that led to additional lockdowns. One of the things that we are looking at from an optimistic standpoint is it seems like with more and more people getting vaccinated and everybody kind of returning to normal with restaurants back open and people going to sporting events, et cetera, that is positive for the overall economy. So to the extent that continues, we view that as a positive. To the extent something comes out where there are additional lockdowns, that's going to be negative. So that's kind of what we're looking for right now. We're keeping an eye on.
If we take a look at how people are currently today, for example, let's assume that someone has the same percentage in growth and income fund and the appreciation income fund before, and the same percentage in RJB. Do they need to take any action to reaffirm their choices? Michael, maybe that's one for you.
Sure. No, there's no action needed. Anybody who is previously, for example, in the appreciation and income fund is now in the growth and income fund in the same amounts. And the same thing for RJB. There's nothing changed other than the names of the funds. If you happen to log onto your account, you will see a transaction called an exchange. So you overnight, a couple of weeks ago, you did an exchange out of the appreciation and income fund and into the growth and income fund. So it was a dollar for dollar exchange. So it's the exact same as you had before.
When we talk about government intervention or influence, Brad, if we take a look at, I think you've tried to answer this question earlier, we'd like to get a little bit more clarification on how you see the government actions going forward. And are we looking for a potential decline and therefore negative impact on the market? Some saying in August, others can't give a date. When I was in the business, I know dates were something we didn't want to talk about, but could you talk a little about a government intervention and potential feelings growing about perhaps we're closer to the end than we are to the middle?
So a lot there. I would say that we absolutely don't comment on short-term outlooks. So whether a sell-off is likely to occur in August or September or Q1. That's not in our sweet spot, so we stay away from that. We look for things over the next 3 to 5 years. And I would say that the type of government intervention that is positive for equities is what's going on right now, which is the Fed has indicated that they're willing to leave rates lower for longer. They're continuing to buy securities on the open market, which is keeping other fixed income yields low. And low yields push people to equities to get higher returns. So there's a lot of positive things out there. That being said, we are getting closer to late market cycles. So with inflation kicking up, if it's not transitory and it is more sticky and leads to stagflation, that could very much be an issue, because that's bad for both stocks and bonds, and there's really no place to hide if we get into that type of a market environment. But our best guess right now, based on what we're seeing, is that with the accommodative Fed and with the stimulus that's out there, it's going to continue to keep rates low. But the one thing, as I said earlier, is that we do need to keep our eye on is just what's going on with inflation.
Hey, Michael, an administrative question. When one takes a distribution, does it come out of all the funds or just one fund? And how's the allocation between funds for the individual distribution?
Yeah, so for any individuals who are retired and are invested in more than one fund, they come out pro rata. So they'll come out in an equitable portion to how those funds your overall portfolio is invested as you make those distributions. If you would like them to come from one individual fund, that is somewhat unique, but you can take care of that. If you call Fidelity, you can probably work that out. It's a little complicated, but it is possible to take it from one fund and not the other funds.
There's a question about our information regarding our ESG funds. I'm going to answer part of it, then I'll let Michael come in if there's something open. When I started this thing, we had and you'll forgive me, rabbis, what I call a bet din. And we're using the several rabbis on the committee looking to interpret both guidance from the CCR Committee on Social Action, the RAC, and the CCAR and their pronouncements. We then take what they have stated as their policies for socialization and group and work them into an investment arena that's managed by a manager, an outside manager that's particularly skilled in this particular fashion. They also, with the help of the bet din, rank certain attributes that we feel are important. Israel, etc., no fuel, fossil fuels, etc., and their commitment to diversity. We have several items that are weighted and give each investment a social score or weighting, and it is then put into the portfolio. So we're using guidance from, as I said, CCAR, URJ, as well as the RAC to guide our performance. Now, I've been in the investment business for well over 40 years, and I'd always been a fundamentalist. This was a real change in attitude for me, but I'm glad to see that it is working, that good companies may eventually become good stocks. We're talking about how they're being governed and how they're being run. The performance speaks for it. We've been heavily invested in technology, as well as lower investment, according to the index, versus oil and fossil fuels related. That's our general approach to this. Michael, I don't know if you want to add anything to what I've said, but that's how we run the ESG, or the Reformed Jewish Value Investment Fund.
No, I think when that summarizes it pretty well. Information about accessing where you can find it, really, it's on our website. It should be pretty easy to find all the information about our Reformed Jewish Value Stock Fund. It is invested like Len said, it's a global stock fund only. And as a global stock fund, it would be considered a little bit more risky than if it were a balanced fund that had stocks and bonds, right? So it is a stock fund only, and you should consider that as you are looking at your overall asset allocation, and in terms of also determining how much you might want to consider incorporating that into your portfolio.
Michael, I think you covered this, just to reiterate, someone to know, how do we set up for the one-on-one fidelity session? I think you said that you have to call. There's only 2 slots open for today or for tomorrow and the day after, but you have to make that call. Michael, can you add anything to that, please?
Yes. Wait, I'm getting a text on how to do that. If you go to fidelity.com/schedule, is how you would sign up for the one-on-one sessions. Just mention you're from the RPB. You'll put in the information, and obviously it's a website, and that will help you get registered for those one-on-one sessions, the special one-on-one sessions.
Thank you. There's some general questions here that I want to throw to David. David, they want to know about, I know from the Canadian view south, maybe a bit more objective, but can you view the view of the regulatory impact on FANG in particular?
Everybody is concerned about the overconcentration of power in a few very large companies. Particularly in the technology sector, it's become pretty much winner take all. Google, Alphabet, winner take all in search. Facebook, winner take all in social media. Amazon, winner take all in online shopping. And these companies are now enormous, with market caps of over $1 trillion, and they have enormous power. So governments all over the world are, of course, concerned with this. And they're also concerned with the fact that these companies probably don't pay as much taxes, certainly as governments would like. So there will be a regulatory reaction. At the same time, nobody's anxious to kill the goose that keeps laying golden eggs. So I believe that the regulatory action will be muted. I believe these companies will pay more tax as time goes on, and there will be more aggressive action taken to try and foster competition. My own view is that as far as competition goes, the horse has already gone from the barn. It's very difficult to imagine companies able to compete with the giants in the technology space at this stage.
David, while you're there, a question has come in about TIPS and its muting effect on inflation. We did cover it, but just to maybe expand it a bit, if inflation seems to be growing in not only importance, but at least in headline risk, would you increase an allocation to TIPS?
TIPS have been a rather poorly performing category for a very long time. My own view is that the inflation risk is greatly overstated. The headline numbers, as Brad said in his commentary, reflect difficulties in supply chains that grew up during the COVID crisis. I think the most indicative category for me is lumber futures, which went from $400 per thousand board feet 2 years ago to $1,800 per thousand board feet briefly in April of this year. A huge increase. They're now back down to $550 per board foot. What the commodity guys say is that the cure for high prices is high prices. We're seeing that in housing sales in the United States, which plunged during June. We're seeing it in all commodities, which are now coming back into line as high prices bring on more supply. With continued unemployment in the United States, and with the ratio of employable people to working people still rather low, I don't see a lot of inflation potential.
Brad, do you have anything to add to that?
No, I agree with everything David said, and it's not something that we believe needs to be addressed in the portfolios at this time. We think you're well positioned. You do have some tips exposure, but I wouldn't be increasing it from where you are today.
Len, let me jump
On
in.
the chart,
Len,
I'm
Len,
sorry?
Len,
Yes, go ahead, please.
let me just jump in for a minute. I'm
Please.
just looking at the clock, and I want to be respectful of our participants' time today. It is 3:02, or a couple of minutes over. There were a number of additional questions that have come in, and what we'll do is we will document these questions, and we will type up responses and share them with all the participants so that we can respect your time. I know people are very busy getting ready for high holidays in just, gosh, a few weeks. Those still working, good luck, Chag Sameach. And for those that are retired, and continue to enjoy your retirement and not
Very
have
good.
to worry about planning for high holidays in just a few weeks. So I really, we'll end it here. I want to thank.
Yep, I just want to, good, thank you. Let me close by saying, we want to thank Maria Rodriguez, without whose help these things just can't happen. And to Stephanie, again, thank you very much for putting this together. It's a lot of effort, and we thank you all. Thank you. Shalom, shalom, Leithold.